This program is sponsored by Wilsey Asset Management.
Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, good morning and welcome to the Smart Investing Show. I'm Brent Wilsey, just about 8:02 on Saturday morning. Great to have you here this Saturday morning and every Saturday morning about your money, the economy, finance, investing, and all those important things to help you grow your net worth. And with me is Chase. Good morning, Chase. How you doing?
Good morning. Doing well.
Well, good. We got a lot to talk about today. As always, I'll give the phone numbers now so that you can be ready about, probably around 8:20, I think, is when we start taking calls. Phone numbers here for that unbiased, no strings attached, fundamental opinion about what you want to talk about. 866-577-2473. That's 866-577-2473. Well, Chase, we got to start off with that big jobs number. You know, people say, what's he talking about, big jobs number? Well, it's always a big jobs number because it's so important to know what's going on with the jobs reports when they come out in the economy. The headline jobs number missed may look like it's a bad thing, a troublesome thing there, but overall there are several positives in the report. To start, the negative in the headline number was, saw a gain of 194,000 workers, which badly missed the estimate of 500,000 workers. Much of the miss came from the government education, as locals saw a decline of 144,000 workers. That's local
education.
What's that?
Local education.
I want to say municipalities, things like that. Local education, like Poway School District, which not to say they are, but that type of thing. And then the state saw a decline of 17,000 workers. Private education, I was surprised on this one, was also struggling with a decline of 19,000. In the report, it was pointed out that pandemic-related staffing fluctuations in public and private education have distorted the normal season hiring and layoff patterns.
Well, because isn't it interesting? Most of the time in September, they have a huge wave of hiring. And it seems as if the pandemic has kind of just caused these interesting fluctuations, which really distorted the numbers. So that was an interesting point. The thing that I was most surprised by is to see a decline of 18,000 workers in healthcare as job losses in nursing and residential care facilities declined by 38,000. And I was shocked by this. Hospitals saw a decline of 8,000. And I do wonder here if nurses are feeling burnt out after a year of COVID. I mean, it was stressful. I know a lot of nurses. And also, too, I've seen a lot in the news about these vaccine mandates and, nurses deciding to quit or getting fired over it. So I don't know if that's what's causing it. I don't want to get too political with it, but it is something that I don't think is helping the situation. Right. So I was shocked by that number to see that the healthcare have that substantial decline. But areas that were strong in the report, and kind of going back to the I'm going to call it the public sector, is we saw job losses there, but the private sector actually was quite strong. And I mean, areas in particular included leisure and hospitality. That was up 74,000. That group was just decimated during the pandemic. Professional and business services saw an increase of 60,000. Retail trade up 56,000. And this one's so important, transportation and warehousing. We know that has been a real struggle to supply chain and the economy, up 47,000. Manufacturing, another area that's really, really crucial to, I think, the inflation potential headwinds and the supply chain issues. That was up 26,000. And also, too, wanted to point out, revisions for the prior 2 months saw an increase of 169,000. So we had a huge miss on the report. Like I said, you can almost recoup that if you take away the public sector job losses and also the increase of 169,000 workers for the prior 2 months. So that was huge. And I think that's what really aided the unemployment rate, which saw a post-pandemic low of 4.8%, which beat the estimate of 5.1%. And wage inflation also remained strong as average hourly earnings were up 4.6% compared to last year. So, again, a lot of negative, and I was watching it in the news in the morning, and a lot of pessimism. But I was even shocked to see Larry Kudlow come out, and, he's not the biggest fan of this administration.
Right.
But he's like, it wasn't bad. And I agree.
Yeah, and it wasn't bad. And when you look at what's going on, and one thing I do want to point out is I do hate the term job creation.
Job recouping.
recouping, replacement. I mean, whatever it is, we're just getting back to the jobs that we lost about a year ago. So, but it is good to see that being done, that jobs are coming back. And there's a lot of ripples that you have to kind of deal with. One, the wages aren't as high as people want. They've saved some money. Maybe they don't want to go back to work. I still hear, I don't want that job. I want my dream job. Well, okay, maybe that's going to happen eventually for you. But it's just very difficult to deal with it. But it's a positive report overall because we are getting jobs back that we lost about a year ago. And one thing I think is going to happen is that people will feel better. If you're working and you're focused on something else, you're not at home watching that we just talked about before, Squid Games on Netflix. I'm sorry, I saw that. I don't know why it's number one. I think it's very poorly produced. It kind of like we're kind of joking. It's like the old Godzilla things where the voices don't quite match up. The acting, I think, is not that good. Why does Netflix get like, it's number one? Like, I'm saying this because I think people are at home. They have nothing better to do than watch these poorly produced shows.
Well, it's like reality TV. I'm not the biggest fan of reality TV. Some people love it. So, we're not show critics by any means, but hey, I don't understand a lot of things that people like, I guess.
I did see a report this past week that the average person in the United States right now, across the country, watches 3.1 hours of TV per day.
Wow, per day.
Yeah. And so my thinking is that if you're home all day, that's pretty easy to do. But if you get up, you go to work, you come home, you eat dinner, I guess that's not too bad. You watch TV from 7 to 10, you go to bed. So
yeah, I guess.
Yeah. So, well, hey, more good news on the COVID-19 defense front. A drug company, Merck, has come out with a pill that can be taken by people at home, and this is similar to taking Tamiflu for the flu. Merck's drug is called, I should have given this to you, Molnupiravir. What do you think?
Molnupiravir.
That looks better.
I feel like that wasn't bad,
be right.
bad attempt.
We'll see if somebody calls in like, no, it's not that, it's something else. But it's about, 13, 14 letters in there. Anyways, as with many drug names, please don't ask me how to pronounce it.
And, the other drugs that reduce hospitalization or death require the infusions, which, I think kind of deter people from it because it's like, I don't know if I want to do that. The pills, a lot easier, and Merck is hoping for FDA approval by the end of this year and said it expects to produce 10 million courses of treatment by the end of the year, and the U.S. government has agreed to buy 1.7 million courses of treatment for $1.2 billion. So, I think this is just another tool in the shed, so to speak, that we can use to move on from this pandemic. And, I want to go back to the unemployment rate. Talking about moving on from the pandemic is if you would have asked us back in April or asked anyone, if we would have had an unemployment rate of 4.8% during the height of the pandemic, people would have thought you were crazy.
Oh, yeah. Now, you taking on April of this year or April of
I said
last
April
year?
of last year.
Oh, last year. I missed the last year part. Yeah. So, yeah. It's just like, it's going to take years to recover and so forth. And again, we talked about how well the drug companies came together. We talked about this on the show, how they came together. Spending billions and billions of dollars on R&D and cooperating with their own research, and how it's just we can turn it around, and that's why I didn't get too upset about it. Didn't like it, obviously. I don't like wearing the mask or all this other crap that you have to do. But you do what you have to do. But we got through it, and I think by next year at this time we'll be talking about some other problem because the Delta. I don't even hear cases or deaths anymore. I think the Delta variant has now been beaten as well.
Yeah, and so it makes the news. It's like, we saw a spike of 10,000.
Right.
Okay.
And what's kind of funny, Chase, is that there's always going to be negative news.
Yeah.
Could you imagine you turn on the TV and it's like there's nothing on. There's always going to be something negative to talk about. COVID, Afghanistan, the government, budget.
Debt
ceiling, all these things. There's, we're going to go from one problem to the other. And when it comes to investing, you can't focus on the problems because you would never invest. You'd be sitting there in cash for your whole life. But you got to realize what to invest in. And that's why we have the show here and realize that, every day you turn on the TV, there's going to be some negative news that some producers came up with, some reporters came up with that's going to scare you, but you got to continue on investing.
Absolutely.
Let's talk about when Apple Pay first launched back in 2014. Banks agreed to pay Apple, and I always want to know this number. I finally found it. They agreed to pay Apple 0.15% of each purchase made using Apple Pay. Well, the banks are now working with credit card companies to reduce that amount that Apple will receive for two reasons. First off, Apple agreed not to come up with their own credit card, and since 2019, it has been working with Goldman Sachs on their own credit card.
Yeah. And then also, second, Apple gets the 0.15% payment on automatic payments like gym memberships and streaming services that reoccur every month for doing nothing. It appears that the banks and the credit card companies are pushing back against Apple, and they will be losing some revenue in the future from what is known as the Apple Digital Wallet. And, I was curious on this as well, as you said, and, how much of it do they really deserve, I guess?
Mm-hmm.
I mean, 0.15%, so small. But you start
but
to
not when you take it-
extrapolate that over, billions of dollars. That's a lot of money.
Yeah.
So I don't know. I think it was a interesting tool to kind of use. I know it actually grew in popularity during the pandemic as people were, not wanting to touch the credit card machine and use cash. So I know it actually probably helped Apple and Apple Pay. But now I am interested, especially when they launch their own credit card. Like, hey, that's not fair.
Yeah. And again, now that think of the millions and millions of people that do streaming services, gym memberships that don't get used and so forth. And Apple just sits there with a hand out collecting that money. Now, I do think it's a good thing when you go to the store and just put it out there and there it is. But I agree with the banks and the credit card companies. No, you shouldn't collect on the streaming services and
I will say it isn't. I mean, Apple has done a great job coming up with these extremely passive ways to do nothing and collect money.
Yeah.
I mean, you talk about this. You talk about the store as well, where if people have in-game purchases, like I know that Fortnite, for example, was suing Epic Games, is the other name they own. Fortnite was suing Apple because they said, well, hey, you're not doing anything. They're buying the in-game purchase, and Apple wants I think, what was it, 30% cut? Or I think it was 30%, amount, but it's quite high. And I mean, they've done a great job coming up with these ways.
I know.
I was like, hey, we're Apple. If you want in, you gotta pay us. So I do wonder how that is going to impact their service revenue, which has kind of been, I'm going to say, the darling of the companies. Oh, it's recurring. It's so great. It's service revenue. It's software. I wonder how this kind of shining light on these two matters is going to impact the future service revenue for Apple.
Yeah, and it's funny. I used to use the Apple Pay all the time, and I use my phone less. I get kind of worried. What is going through that phone? What's on there? What can people see? And then I got out of the habit. And now I just use my credit card. And sometimes I slip way back 10 years ago. Listen to this. I try to give them my credit card to run my credit card. They kind of look at me like, no, put it in the machine.
I thought you were going to say you use cash. And I was going to say, what is that?
I use cash once in a while, not very often.
Well, hey, you got to use the credit cards because you get points and rewards. And,
oh, yeah.
So, I mean, I never, I don't want to say never. I hardly use cash unless it's for like tipping or, I can't, or if they charge you a service fee on the credit card or debit card, then I'll use cash. But, it is something interesting to kind of keep an eye on for Apple.
And actually, interesting point too, Google Apple Pay, they do not collect 0.15%.
Google Apple Pay?
Oh, no. What do they call it? Google Pay?
Yeah, Samsung Pay. I know what you're
That's why you look at me like, what's wrong? Oh,
See,
yeah.
but it's like a Kleenex,
Yes.
I mean, Apple's branded it so well.
They've done a great job with that. You're right. But Google, on their Google Pay, they do not collect that from them. So from the banks and the credit card companies. So, hey, let's talk about one more. We got a couple minutes here. I did want to talk about the easing of the COVID-19 restrictions has been a bad break for Peloton as the workout sessions are declining. For the second quarter ending June 30th, connected subscribers averaged 19.9 workouts per month, per user per a month. And that is down from 24.7 workouts per user a month 1 year ago. That's about a 20% decline.
Yeah, and it is especially troublesome for a growth stock. And it's expected the 19.9 will be even less during the summer months as many users talk about getting out more for hikes and other outdoor activities. So it'll be interesting to see as those summer months what actually happened with Peloton. We don't have the exact numbers on it just yet. And at a cost of $1,495 with the option to pay $39 a month for a live stream and recorded workouts, I wonder if this company has seen its best days, especially, I mean, $39 a month, that's almost like a gym membership.
Well, yeah, it is, and that's like $500 a year. I mean, and on top of what you paid for the machine.
Yeah.
And I know people that have them.
Love them.
They love them. But, I mean, the stock has suffered. The stock was, over $150 last December. Last time I looked at it this past week, it was down about 80, about a 50% decline. I don't think there's much left for this company. And again, I know like in our office, Eladia, she says she loves hers in the morning. There's people that still use them, but I think there's going to be less and less people. Now, we do have the winter coming up back east, which maybe that could help them. But still, I mean, your first year cost is $2,000. I mean, that's an awful lot of money, I think.
And it's kind of like we talked about earlier about the Squid Games, whatever the show's called. I don't even know. I haven't seen it. You
got to watch it just to get your own opinion of it.
You
got Netflix, right?
Yeah.
Okay. Yeah.
But I don't understand some people's preferences. Like I don't understand the whole spin cycle thing. I was talking to my buddy yesterday, and he's like, "Oh, I went to a spin class, and it was so fun because there's like music on, and it's like kind of competitive against one another." Yeah. I'm like, okay, I kind of get that more than the Peloton thing. But I hate riding a bike. It's so uncomfortable.
I know. It's my butt.
Yeah, and it's just it's not a fun workout. Like I don't understand the allure to it. But I mean, like I said, people love it. So I'm missing the trend, and I've tried it. I don't like it. So just not for me. And I know there's other people that feel the same way out there, and especially at this cost. I just wonder how much more this company can grow. And people, well, they got the subscription revenue. Again, that's the big thing on Wall Street right now is, the reoccurring revenue. Well, guess what? For it to become non-reoccurring, people just have to say, I don't want to do this anymore. Right. So I don't know how much I would value this company at, especially I think the kind of like what we saw with Zoom, I think the pandemic pulled forward a lot of that demand, and I think that future growth is going to be a lot less than was originally anticipated because it was all pulled forward.
And actually, I looked online. There are used ones out there you can buy, and actually, a little bit of problems at home with the bride-to-be because she wants one. I say, you're not going to like it.
Costco, they have one.
Costco has one?
They have a knockoff. I forget what it's called.
Really?
Yeah.
But do you get the streaming? Because that's what she likes, too. She
I
likes
believe so.
Yeah. Really?
Yeah.
Okay, so, well, maybe she's not listening to this, so I can still kind of like, nobody else is using them, so, but maybe I'll check out Costco.
Yeah, I'm trying to see if I can find it.
Find it there.
Yeah, I don't know.
But again, I'm just kind of pointing out that with the company, growth company, I think their growth has seen better days, and you can see the stock much lower. I'd say a year from now.
Yeah, I don't know what it is. It looks like it's called the Echelon. It's $1,099, but it includes 1 year United membership. Not exactly what that means, but
right. I've actually heard some of the people, the exercise people that do the videos. I guess a couple of them have become celebrities. We're on Dancing with the Stars or something.
Wow.
Yeah, so they become celebrities because wow, they got this super high energy personality and they become stars. But we'll check that out. Maybe for Christmas. I don't know. We'll see.
Yeah.
All
I
right,
bet you she'll use it for a few months and then hate it.
I know. Well, yeah. And there it sits. And actually, I saw pictures. I was reading about this. I saw pictures of ones in the bedroom as a clothes rack.
Yeah.
Pretty expensive, a $1,500 clothes rack. And then I wonder if you still, here's the other thing too, and then we'll get to the calls, is that people will forget to stop the monthly payments. Yeah. I got to do that. And Peloton may collect those for months if, who knows? Maybe even years where people, I still haven't stopped that $39 a month.
Yeah. Phone
number is 866-577-2473. That's 866-577-2473. Let's go out to Coronado and speak with John. John, you're on the Smart Investor over in Chase. How can we help you?
Yeah, hi, guys. Tell you what, the stock I'm looking at is General Motors.
Okay. And go ahead.
I don't own it, but, last week they came out saying they're going to double their revenues, and the stock's pretty much down about 20%, I think, off its highs.
Okay. And I'm kind of surprised you don't own it, John. I know you've been a listener of the show for quite a while. I thought for sure you had General Motors in your portfolio, but let's kind of talk about General Motors a little bit. Their symbol is GM. They are obviously in the industry of auto manufacturers. Short percent of float is only about 1.6%. They are owned 83% by institutional share ownership. We do see that the PE ratio is 6.8. That's well below the industry at 19.4. Price of sales 0.6, half the industry at 1.2. Price to book value 1.7 versus 2.2, and price of cash flow for General Motors also looking very good at 3.2 versus 8.6. And we love the PEG ratio, which is the price earnings divided by the growth, how much you're paying for the future growth. Not much for General Motors. It is 0.9 versus 2.7 for the industry. Now, earnings per share over the last year have climbed by 287%, well above the industry at 70.9. The 5-year growth on earnings is flat, about the same as the industry at 0.1%. Sales growth for the 1 year had increased by 20.6%, also well above the industry at 4%. And the 5-year average sales are down 2.9% for General Motors, but it was down by 6.2% for the industry, so looking pretty good there. General Motors still not paying a dividend. I thought they would come up with it by now. Maybe we'll probably be hearing pretty soon, I guess, maybe another couple weeks, the earnings report coming out. Maybe then they'll announce it then. We'll see. Looking at the balance sheet for General Motors, we see a current ratio of 1.1. That is below the industry at 1.6, but I'm okay with that. Debt to equity 220 versus 0.8. But keep in mind, a lot of that does include refinancing or financing of cars. We do see that the net profit margin for General Motors, 9.1%. That is better than the industry at 6%. Return on equity is very good for General Motors, 24.3, double the industry at 12.2. Chase, what do you got for the earnings going forward?
So let me start here with the current price, $58.57. 52-week high here, $64.30, and the low is $30.95. Year to date, the stock's up about 41%, so it's done well, I think, as the whole EV wave has occurred. I still don't think GM gets the type of respect they deserve. No. Especially at their investor, you already mentioned doubling the revenue. They also talked about expanding margins as well. So I saw one of the analysts talk about double revenue, but also triple. I don't know if it was EBIT or just their earnings per share. But either way, to be able to expand that far in the next 10 years, that's a huge growth rate. So I like that. They've also talked about expanding different areas. It's not just the old auto manufacturer. They talked about their company BrightDrop, which is more kind of business services. They've talked about other services that they can implement with the car, including Cruise. And they also talked about GM Defense. So, they're really kind of setting up different business lines, which if they can execute on this stock, I think is severely undervalued. And I talk about that because, you look at where it's trading. If I look out to December 2022, the estimated earnings per share, $6.83. That gives us a target sell price of $113.38. And the forward PE is just about 8.6. The stock is just, I don't think, respected enough, right, especially if they can execute on what they've discussed.
And John, the big problem is, will they get beyond the automotive side? Because they're still trading as an automotive company, and they're looking more at being like almost a software company on wheels. I've heard them talk about with the Cruise and everything else they have going on. I forgot about GM Defense, another area that does very well for them. So I know they've up 15% over the last week or so on their announcement. And I was wondering too, Mary Barra, how old she is, because she talked about 2030. So I'm hoping she'll still be around. She's a great CEO. She looks pretty young.
I think so.
Well, yeah, I'm 65, so she's my age.
She's 59.
Oh, 59, yeah. So she's young. Oh, yeah, she got another 10 years to go for easy. Yeah. So, but I don't know if I like it at this price, because I feel that with a current price up to $58 a share, it made it maybe a little bump there. So maybe be patient with it. What do you think, James?
And I was going to say, call me crazy here. This is probably going to upset some listeners that are looking at GM. I don't know if they're going to re-implement their dividend.
Really?
I think that they're trying to shift the tone of General Motors and become more of a growth company. And, I think that they have more valuable use for that cash investing in EV and AV rather than paying out a dividend, which I think, as I said, is going to upset some of the prior shareholders. But the reason I say this is if you listen to the conference calls, listen to the executives talk, they've really tried to drop anything related to the dividend. At first, they're like, oh, when's the dividend going to come back? And now it doesn't even come up in the conference calls. So I'm not sure if they're trying to kind of move on from that and invest and then perhaps pay that down the road. But that's just kind of my feeling on the dividend right now. And it doesn't upset me in terms of the stock because it's a great value.
Right. So, hold a business is nice when they pay a dividend. I don't know what the dividend costs them. I think last time I looked, I think they had like $25 billion in cash. I want to say that the dividend costs them about $4 billion a year. These are guesstimates, so don't use them. Actually research them. But it's a possibility, but I still think they'll want to try to do both. Yeah. Take care of the not old investors, but the normal investors that like the car companies, give them a small, maybe 2% dividend, but yet still keep that money to grow Cruise. And I also heard them talking about doing battery plants and so forth. So they're really an innovative company. So we'll see. We like the company, John. I just think that if you buy it now at this level, you may be regretting it maybe in a week or two because it pulled back a little bit.
Well, it might be one to sell puts against it and wait for it to come down, I guess.
That could be an idea. Yeah. So, all ready?
All right, thanks.
All right, John, good talking to you. Have a good weekend here. Bye-bye. All right, that does open the phone line, 866-577-2473. That's 866-577-2473. Let's head up to Oceanside and speak with Carl. Carl, you're on the Smart Investor over Brent Chase. How can we help you?
A few years ago, I stayed at the Red Rock Hotel in Vegas, and I looked at the chart. It says 90% of institution own the stock. So what is good for the institution should be good for me too. So I bought it. It is in an uptrend. I'm wondering what is the value of that Red Rock?
Okay. Well, let's see what we can see here for Red Rock Resorts. I like their symbol. Very easy to remember, RRR. They do have a short percent of float, about 6.9% short. You're right, about 93.3% is owned by institutionals, which could be good, could be bad as well sometimes, can work against you. We do see a PE ratio of 39.8, which is high, but the industry of resort and casinos don't even have a PE ratio, so that's a positive there. Price of sales looks good, 3.4 versus 3.8. Price to tangible book value is over 100, but however, the industry doesn't even have a price to tangible book value, so that is good. Price of cash flow, 8.7. That is positive. The industry is over 100 there. We do see on the earnings per share growth for the last year, nothing there, nothing for the industry. We do so over the last 5 years. Red Rock has grown at 19.7%. Industry, nothing there. We do see on the sales growth for the 1 year, up 13.7%, beating the industry down 10.3%. Sales over the 5-year time has increased by 1% when the industry saw a decline of 10.9%. Now, this is not good here, Carl, because looking at the 5-year earnings per share growth estimate, I do see 100. Wait, what was I looking at? Oh, I missed the PEG ratio. How did I miss the PEG ratio? That's what I thought I was going to do. The PEG ratio does look good. It's 0.2 versus 5.5. The 5-year earnings per share growth estimate is 165% versus 38. So that does look pretty good. They do not pay a dividend. Let's take a look at the balance sheet. A nice current ratio here of 4 versus 2.2. Debt to equity, not very good. This looks like 800, which is about the same as the industry. And usually casinos have high debt, which worries me, especially during slowdowns and changes in the industry. And I do wonder, two of these companies with the online gaming and gambling, is that going to take away from the casinos? We'll see on that going forward. We do see that they have about 8.1% in intangibles. That's pretty good. Net profit margin, 6.5%. The industry is a negative 16.6%, so that's a positive compared to them. Even the return on equity for this company looks pretty good, 28.2%. The industry is a negative 17.6%. So kind of mixed on this company. I think it's going to depend on what you come up with, Chase, going forward for Red Rock.
And I will say real quick on the debt to equity, a lot of times when I look at the casino companies, I look at the hotel companies, resort companies, they're what we call asset light. They don't own the properties. They rent the properties, they lease them, and then they run the operations. So a lot of times these asset light companies have these really bad debt to equities, and it's just something we don't feel comfortable with. It's a different business model, and a lot of these companies I think will be fine with the high debt to equity, but it still just doesn't fit what we do.
Right.
So it's I don't want to say it end all for the company at an 800% debt to equity, because I'm assuming they're an asset light business, but just want to point that out there that they might be okay, but it just doesn't really fit into our criteria of businesses we look at.
And Chase, one thing an investor can do is kind of look at that, say, okay, well, let me see what the debt really is. What is the real cash flow? Are they paying down this debt? So the return to equity, debt to equity is something you want to look at. It we say is a negative, but if you're going to understand the numbers, and we're trying to do a quick analysis live on air here for people to try to point them in the right direction. But that's where you go to say, well, okay, but I like this company. Let me really check to see is their debt increasing, decreasing? How's their cash flow? You know, these other
And they pay their interest with their cash flow, things like that. So I just want to point that out, Carl. It's not an end all for a company because they are asset light. Just wanted to make sure you understand that this type of business is a little bit different when they operate that type of business. But let's take a look at the numbers here further. The current price for the Red Rock Resorts, $53.83, 52-week high here, $55.82, and the low, wow, $17.31. Year to date, the stock's up 115%. So it's done very, very well. But if I go forward to December 2022, I see estimated earnings per share of $2.17. What gives a target sell price of just $36.02? So I do worry that, like a lot of the other post-pandemic plays, the recovery plays, that this stock may have gone too far. I don't think the value's there any longer, as the reopened trade, as we'll call it, has, I think, as I said, gone too far, and I think this business is no longer a great value as it was at the beginning of the year.
And Carl, did you say you stayed at the Red Rocks in Vegas or something?
I liked it because it was a little bit away from the razzle and dazzle over there from the strip. It was more quiet, and I liked it. But I bought it. I'm now a little bit in profit, but maybe I should sell it to keep the profit I have now, because it might, might go lower again. So, or put the stop loss someplace. So, yeah, I liked it. That's why I looked into it.
Yeah, and I mean, based on what we're seeing, it does look like it's pretty richly valued. Not to say it won't go higher, but it sounds like you have a profit. Maybe what you want to do is sell that, get out of that, and find another business trading around, 10, 12 times earnings that's on sale, as opposed to being fully priced or perhaps overpriced. All righty?
Yes. Very good. Thank you.
Okay, Carl, thanks for calling. Have a good one. Bye-bye. All right, that does open the phone line. 866-577-2473. That's 866-577-2473. And Chase, I do wonder about the gambling situation, because, again, you got these companies now that are doing all the gambling online. They make it so easy. Is that going to prevent some people saying, I don't need to go to Vegas anymore. I don't need to go to New Jersey?
I don't know. But Vegas is so different.
You still get excited about Vegas.
Yeah, I think that one's a little bit different.
Yeah. So, all right. Let's go out to San Diego and speak with Wayne. Wayne, you're in the Smart Investor Brent Chase. How can we help you?
Good morning, gentlemen. I'd like to hear what you think about a stock called Vishay Intertechnology, symbol VSH, their electronics producer.
Okay. And do you hold that or looking to buy it?
No, waiting for your opinion.
Okay. Well, I'm glad you said that, because a lot of people, they will buy it on Friday and then call us on Saturday. What do you think? So I'm glad you called in first, and then maybe buy it on Monday. We'll see here.
Well, I couldn't find a definitive answer what the future earnings are supposed to be. There's like a 30-40% difference on what reporting agency you look at. So that's what I'm concerned about.
Oh, okay. All right. Let's take a look at Vishay Intertechnology. Symbol is VSH. We do see not much on the short side, 1.2%. They are owned by institutionals, 80.6%. Not a great start here in the PE ratio, 24.5, but the industry is at 27.6. We do see price of sales 9.1 versus 9.8. That's a positive. Price to tangible book value 7.9 versus 8.1. That is good. And also price of cash flow for Vishay looks pretty good too at 19.3 versus 32. The PEG ratio, which is price earnings divided by growth, 0.8 versus 1.3. And the lower that number, the better. So that's another positive. Now, their earnings have grown for the past year by 53.5%. That's a good growth rate, but the industry was up 98.8%. The 5-year growth rate for Vishay, though, was 39%. That does beat the industry growth of 26.5%. Looking at sales for Vishay are up for the past year, 32.7%, above the industry at 22.5%. And the 5-year average on sales for Vishay is 33.5% versus 19.3%. And the 5-year earnings per share growth estimate, 28.6% for Vishay. That's above the industry at 20.5%. They do not pay a dividend. I believe they used to pay a dividend as well. It wasn't a very big one, but I think they cut that. We'll see if they bring that back. Look at the balance sheet. I know Vishay's always had a pretty good balance sheet. So they got a current ratio of 5.4 versus 3.1. So apparently they're sitting on a lot of liquid cash right now. You may see that invested in the future. Maybe they'll do a stock buyback or something. Debt to equity looks pretty good, 10% versus 20% for the industry. Intangible assets, about 11.6% of the balance sheet or the assets versus 10% for the industry. We do see a net profit margin. Wow, 37.2% for Vishay versus 27.5% for the industry. And return on equity is 28.2% versus 25.5%. That's a positive as well. Chase, what about the earnings going forward?
Yeah, so current price here for Vishay, $20.16. 52-week high, $26.50. That 52-week low is $15.81. Year-to-date here, pretty much flat. Stock's down 1.4%. Market cap for the business, close to about $3 billion. So it is a pretty small company here. But if we look forward to December 2022, I see estimated earnings per share of $2.30. Gives us a target sell price of $38.18. And, I mean, that looks quite attractive. The numbers look good for it. It just seems to be a stock, though, that just always trades around 15 to 25, and it just kind of stays in that range. But and kind of as you pointed out there, Wayne, I mean, the range is huge. I mean, $1.68 to $2.70, that's a huge difference. So
somebody's going to be wrong.
Exactly. Yes, somebody's going to be wrong there. So I don't like to see that big of a range. I just don't feel comfortable with it. I guess is the way I would leave it.
Yeah, I think it's not on sale, and it's kind of like, and we've talked about this before, is just buying something to buy something. You're just not getting a good deal on this. Not to say it won't go higher, but there's just not like, it's okay. But I would
pull back to $15 would be more enticing. I agree. I think.
Yeah, I think that's when you buy things on sale. That's the time to buy. Already?
Can I ask a general stock market question?
Sure, Wayne. Go ahead.
What do you think is going to have a bigger negative effect on the market? Higher oil prices or higher interest rates?
They're both going to.
We got both.
Yeah, they're both going to happen. So I
think it's higher interest rates. I think the higher oil prices. I think companies will be able to kind of pass that along to consumers, and I think it's going to create inflation, which then in theory will drive interest rates higher. So they're somewhat correlated, I believe.
And the other problem too, because you talk about the general market, we've talked about 5 companies make up about 23% of the market. Well, we know that rising interest rates is a headwind for technology companies, and those 5 companies are technology. So if they start having problems and pulling back, 10, 15%, that will, in my opinion, drive down the whole market, because energy is probably about maybe 5% of the whole market.
Well, and also you think about oil prices. It's not really going to impact Facebook. It's not really going to impact Apple. It's somewhat in transportation costs, but I don't think it'll be as big of an impact for some other businesses, so as it will be for some other businesses. So to answer your question there, I still think interest rates, because as Brent said, I think as those interest rates climb, that kind of reduces the future value of those companies, and I think that's what's going to really hurt the growth stocks, is rising interest rates. So oil prices, not a benefit to many companies, but I think rising interest rates, bigger factor.
Yep. All righty, Wayne.
Thank you, gentlemen. Have a good day. Appreciate your help.
You too. Thanks for calling. Have a good one. Bye-bye. All right. That does open the phone line, 866-577-2473. That's 866-577-2473. Right now, about 8:40, time to talk to our financial planner, Harrison Johnson. Good morning, Harrison. How are you doing this morning?
Good morning, guys. Doing well. How are you doing?
Good. I like the topic this morning because I think a lot of people just blindly refinance. And you're talking about refinancing before retirement. Is this a good thing or not? So explain to us.
Yeah, so in the last 18 months or so, interest rates have been really low. I've talked about this before on the show. A lot of people are refinancing, and in many cases, I think that's a good thing. If you can get a lower rate, it helps out your cash flow. You can save more. You can withdraw less from accounts. It's usually a good thing. But something that comes up with people that I'm working with is, a lot of people I work with are planning on retiring soon, maybe within a couple of years or so. And sometimes I see people and they're getting ready to retire and they have just refinanced to get the low rate and everything. But in some cases, they just refinanced into a 15-year loan. Generally, when you're refinance, it's either a 15 or 30 year that you're looking at. But people like the 15-year loan because generally you can get a lower rate than the 30-year, and also you're going to pay it off sooner, so you pay less interest over time than you would a 30. But the situation, especially when you're getting ready to retire in a couple of years, you have to be careful of that 15 years is going to have quite a bit higher monthly payment than the 30 does. And so you might be able to afford those payments now while you're working, but then if you retire, that cash flow is going to be completely different. You don't have the wages to sustain that payment anymore. Now you have that income coming from Social Security, IRA withdrawals, Roth, trust distributions, rental income, whatever it is, but it's coming from a completely different source. So the cash flow is completely different. So it's something to be aware of. Also, in many cases, people retire early, which is not a bad thing in itself, but that might mean you don't have Social Security income yet to help with those payments. Also, if you retire before 65, you're not eligible for Medicare yet, so that means you might have to have COBRA health insurance or get health insurance through the open market, which is a lot more expensive than Medicare. So extra costs there. If your retirement income is coming from mostly pre-tax accounts like an IRA, all of those withdrawals to pay that mortgage are going to be fully taxable, which increases your taxable income, causes you to pay more taxes. So when you look at the tax impact, the opportunity cost, the cash flow, the withdrawals from these accounts, in many cases, that 15-year loan, although it has a lower interest rate, ends up costing you more money holistically than a 30-year loan. So you want to be really careful about the terms of the mortgage that you refinance into if you are getting ready to retirement or, any situation that you're going to look at going forward.
And I was going to ask, what is the difference? So I hate to put you on the spot here, but I think I saw the average 30-year right now is like $299 or something crazy. But I mean, for a 15-year, what's the typical interest rate? Is it like 2.5? Like, what's the interest spread on that?
I would say the spread, it might be somewhere between 1/8 and 3/8. Mortgages are sold in eighths, so 3%, 3.125%, 3.25%, 3.375%. So they're sold in eighths. So if you get a 15 relative to a 30, you're probably going to save 1 to maybe 3/8% on that. But, taking out the retirement factor, when you're looking at a mortgage, as you said, Chase, these interest rates are really low across the board. And so I like 30-year mortgages better than the 15-year, even though the interest rate might be slightly higher, because that payment is a whole lot lower. And so when you look at the net present value of those cash flows that's required to pay that mortgage, it's actually less than the 15-year. But it's especially more important when you're getting ready to retire and your income structure is going to totally change.
And Harrison, I think a lot of times the brokers come in, the mortgage brokers like, oh, this is going to save you money and this is so much better to have your mortgage paid off and stuff. This is why it's so important. That's just one factor of the overall financial plan and the estate plan of people. This is why you need a good financial planner to say, well, you know what, the mortgage broker, he might think it's great just because the rate is lower and you'll pay it off faster, but it doesn't fit for your situation, for your retirement plan.
That's exactly right. I have a lot of friends who are mortgage brokers, and I try to tell them to use this net present value way of explaining how mortgages truly cost, as opposed to, oh, you're going to break even in so many years or whatever based on the cash flow. And, it's a totally different way of looking at it. But the way I look at it is it's a holistic approach, not just the monthly payments that you make, well, how are we going to make those payments? Where is that cash flow coming from? What's the tax impact of those cash flows? How is that going to change over time? What's the tax deduction that you're getting from the interest if you itemize? There's a whole lot more things you need to understand when you're looking at a total financial plan as opposed to just looking at a mortgage.
Yeah, and it's not that mortgage brokers are trying to do the wrong thing. They just say, well, gee, the rate's going to go down. It's going to be less time, so therefore it's better. They don't understand how to use net present value, how to look at the whole situation. That's not their job. That's where you have a good financial planner. And again, as a financial planner, we do have at Wilson Asset Management where they can call you during the year. They pay a special, fee that they're kind of on retainer. You're on retainer. So they call you for things like this. And you can actually do the calculating saying, yeah, this is good for you. Like, you know what? The rate's lower, but it's not going to be better for you. So.
Yeah, and I can explain the numbers on how that works. And over time, it really adds a lot of value for people. So, again, it's something that people out there listening should really be aware of when you're thinking about refinance. Refinancings are good. I don't have a problem necessarily with people having mortgages in retirement as long as you have the income to cover it. But you want to make sure you're selecting the right terms in order to do that refinance.
That's correct. Well, Harrison, thank you very much. We'll see you Monday morning. Thanks for calling in this morning.
All right. Thanks, guys. We'll see you Monday.
Okay. Bye-bye. Again, that's Harrison Johnson, our financial planner. He is a CFP. He's on a salary at our company, so it's not like he tries to sell product. He's there to be your true financial planner, the man that's in your corner to help you do the best financial decisions going forward. You want a free consultation with him, you can go to our website, smartinvesting2000.com. That's smartinvesting2000.com. You can also call and talk to him directly at 858-546-4306. That's 858-546-4306. When you do that, listen for the prompt. His name comes up, and I think he's number 5, on the prompt. But whatever it is, listen to it. I always try to guess that. I shouldn't guess that. Just when you hear Harrison, whatever number is, hit that, and you can talk to him directly. 858-546-4306.
Well, I don't know if you give out the website. They can also contact us on the website, smartinvesting2000.com.
Yeah, I did. Yeah,
okay, perfect.
I kind of flipped it this time.
That's easier. I think,
that's easier.
people, yeah.
For some people just want to pick up that phone and just dial it, But it's easier to remember smartinvesting2000.com than 9 numbers.
Yeah.
So or 10 numbers. 9 numbers. 10 numbers.
Yeah.
Yeah. Phone number 7 plus 3.
Area code. Yeah. Plus 7.
10 numbers. All right. All right. Phone numbers here 866-577-2473. That's 866-577-2473. Let's go out to San Diego and speak with Tim. Tim, you're on the Smart Retro with Brent Chase. How can we help you?
Morning, guys. My Padres stock is in the toilet till next year. Looking at a new mineral company, and they specialize in natural gas. It's Falcon Minerals. I was wondering if you could run the numbers behind it.
All right. Well, let's do that for you. Again, the company is Falcon Minerals, symbols FLM, and they are in the oil and gas EP industry. Not much short on this company, only about 1.6. That's good, but also not much institutional either, about 63%. I thought that would be a little bit higher. There is no price to earnings versus 45.2 for the industry, so that tells me over the last 12 months, no earnings for Falcon Materials. We do see price to sales are expensive, 5.3 versus 3.4. Price to book value, 1.9. That is better than the industry at 2.8. Price of cash flow checks in at 8.4 versus 9.9. And the PEG ratio is 5.9 versus 12.5. Now, it is better than the industry, but still 5.9. That's kind of an expensive PEG ratio. I'm not too excited about that. Now, look over the past on the earnings. They've had no earnings growth for the 1 year or the 5 year. We do also see that the sales growth for the 1 year is 12.7%, not quite as good as the industry at 14.2. The 5-year earnings per share growth estimates only 3.1 versus 5.6, so that's not a positive. Now, the exciting part here that you probably see is they pay a dividend, and not just a dividend, but a dividend with a 10.9% yield, which is above the industry at 2.5. The problem is the payout ratio is not material because they don't have earnings to pay this dividend. The problem could also be that, will they cut this dividend down the road because they don't have the earnings to sustain that 60-cent per year dividend? That would worry me somewhat there. Looking at the balance sheet, we do see a current ratio of 1.7. That's okay versus the industry at 2. Debt to equity 0.3 or 30% versus 40% for the industry. We do see that the net profit margin is a negative 5.7 versus a positive 1.4. and return on equity is a -2 versus 9.3. Tim, I don't like what I'm seeing so far here. Chase, you got anything positive?
Well, I was going to
for
say,
Tim?
too, on the dividend yield, I wonder if it's a special dividend, because I look at the dividend 1 year change up 400%.
Yeah.
I mean, that's just not an ordinary thing to increase your dividend 400%. So I wonder if it was a special thing that they provided. I don't know if that's something that, not necessarily they even cut it, but if
Right.
it was just a one-time payment. So
And if you're losing money, why would you pay a special one-time dividend?
well, and it looks like
Questions.
yeah. I will say it's in the oil and gas industry.
Yeah.
So last year was a very difficult year. They may have sold off some assets or something, generated some cash flow, and said, "Oh, we'll give this back to our shareholders." So that's something potential. And I say that because I know what's happening with the earnings going forward, so I can kind of talk about
You got a
the numbers
cheat sheet over
ahead.
there.
So,
Yeah.
but I do want to start with the current price here: $5.50, 52-week high $5.66, and the low here $1.82. Of course, with rising oil and gas prices, this company has been a huge benefactor. As year to date, it's up about close to 90%. Market cap though tiny, $258 million, so very, very small. But if I go out to December 2022, they are estimated to make money. So I knew they're not going to continue to lose money. 34 cents is what analysts are looking at here. What gives a target sell price, unfortunately, though, Tim, of just $5.64. So it would be in the hold category in terms of the valuations. To be honest, I just don't think it's really worth the energy here.
Oh, good little pun there. Yeah. Yeah, and I think a lot of these energy companies, again, you said the low was, what, $1.82?
Yeah.
I mean, that was probably the time to buy these companies. They probably looked so sick back then, it was hard to do that. But it seems now some of these are becoming fully valued. I know the ones that we have in our portfolio, they're really pushing that full value level as well. So not the time to be buying these companies, Tim. If you missed them, kind of be patient. We'll see what happens. Although we do think energy is going to keep going up in price. So, all righty.
Thank you very much. Sounds like it's like the Padres. You know, we missed 2021, but we'll back in it in 2022 maybe.
We'll start all
Have a good
over
day,
again
guys.
in, April, right?
Yes, very soon here. Catchers and pitchers will report in February.
Thanks for calling, Tim. You have a good one.
Bye.
Bye-bye. All right, that does open the phone line, 866-577-2473. That's 866-577-2473. Let's go back out to San Diego and speak with Rose. Rose, you're on the Smart Investor Show. Brent Chase, how can we help you?
Hi. I wanted to ask you about Richardson's Electronics. The symbol is RELL.
Okay, and
It spiked up here. No, I don't own it.
Okay.
I'm thinking of buying it because I like the dividend. It's 2.3. And it spiked up here recently, and I don't know why. I'd like to see it come back down to around $10. But anyway, I wanted your thoughts on it.
Yeah, well, let's take a look at Richardson Electronics, symbol is RELL. Only 2% on 0.2% on the float, so no concerns with short shares. We do also see institutional ownership 55.2. Not a good start here on the PE ratio, Rose. It's 27.6. That's well above the industry at 20. Price to sales, however, does look good, 0.8 versus 1. Price to book value 1.3. That's very good because the tangible price to book value for the industry is at 23.4. No price to cash flow versus 11.6. Looking at the PEG ratio, I see 1.4 versus 16.5. That's a positive. Now, I do not see any earnings growth for the 1 year or the 5 year, but on the sales side, I do see for the 1 year, sales have grown by 14.9%, when the industry grew by 20.1%. In the 5 year average, they're up 5%, when the industry fell by 3.7%. Now, you're right, they do pay a 2.1% dividend. However, the payout ratio is very high. They use 184.6% of the earnings to pay that out versus 29.9% for the industry. Now, again, they could have had some accounting issues here where they had to, maybe have some write-offs or something, but you want to check, can they afford that dividend? It's only 24 cents per share, but why is the payout ratio so high? You want to get the answer to that question. We do see that they have on the balance sheet a current ratio very good, 4.2 versus 2.6. Debt to equity, 0 for Richardson Electronics. That's a positive versus 50% for the industry. And we see net profit margin 0.9 versus 4.9 for the industry. And return on equity is 1.4 versus 12.6. And those numbers kind of tell me there's something else going on the accounting side which is why that payout ratio looks so strange. Chase, what about the numbers going forward?
Yeah, so current price here for Richardson Electronics, $11.57, 52-week high, $12.45, and the low, well, that's $4.10. So it's up 152% year to date. I mean, it's done very, very well here, Rose. Problem I see, market cap is just $154 million. So it is a tiny, tiny company. And that's a big problem for us because I don't see any analyst estimates going forward. So I can't really derive anything. You're kind of on your own here. If you were looking at buying this, there's no real, I'm going to say guidance, which is always a difficult thing for investors because it's hard. And I'm also not surprised by that because you talk about the institutional ownership only being about 55%. So it just doesn't seem like it has that adoption by the institutions just yet, which, as I said, kind of leaves you to fly solo here.
And Rose, where'd you find this company? Where'd you hear about it?
I don't remember. I just don't remember. I wished I was trying to figure that one out while I was on hold. Where did I find this?
Maybe you were dreaming one night and just came up with it, woke up the next morning like, oh, what about Richardson Electronics?
There you go. That's a good one.
Yeah, so, well, obviously we're not excited about it, so you have to come up with another one for us next week.
All right.
Okay,
All right,
Rose?
will do. Thank you.
You're welcome. Bye-bye.
Bye.
And, it's always interesting looking at those smaller companies, and it's always hard to kind of, I mean, we can't buy them because we would move the market, especially $154 million.
Oh, yeah.
But there's been some small caps that are interesting. This one I just don't have enough info on. So
Yeah, the thing when you buy a small cap company like that, even though the numbers may look good, if you have no institutional ownership or no analysts following it, sometimes it's hard for that company to move because it's almost like a meme stock is what you need. You need a bunch of individual investors say like, wow, this is great to drive that share price. But if nobody's talking about it, it's not on the business channels, it's not in Barron's or Wall Street Journal, many times a good company can languish for years, even though they have strong fundamentals, being a small $150 million market cap company.
Yeah, no, definitely. But I did want to take a few minutes here, if that's all right. Yeah, Breast Cancer Awareness Month, month of October already. Gosh, time just flies by. I did want to talk about my charity for a couple minutes here. It's called the Fighters Fight Foundation, and we're actually running a T-shirt competition right now on social media. I think the T-shirts are pretty cool. For those on Facebook, I'm wearing it right now. Pretty comfy. But if you actually go to our website, donate $30, we'll send you a free T-shirt. And if you post that on Facebook, Instagram, LinkedIn as well, and tag us on it, your name will be entered into a raffle. And if you win, it's a $100 gift card for the San Diego restaurant gift card. It includes restaurants like OG's, Sammy's, Capri Blue, and also Pacifica Del Mar. And there's many, many more restaurants on there. So it's a pretty good deal there. You get to help support women with breast cancer. And also, too, you get to help raise awareness during Breast Cancer Awareness Month. And you could win that $100 gift card. And just to let people know, where's that money going? It's going towards experiences with women and with breast cancer, obviously. And our holiday season is ramping up. So right now we're working on a Thanksgiving experience for, Thanksgiving dinner from Honey Baked Ham for women. And then also, too, we're excited about our Christmas experience where we actually kind of, I'm going to say, adopt families here, bring in a Christmas tree, Christmas tree decorations, and also, too, provide presents for their kids so they don't have to worry about, the time. They can just focus on their families. So we're excited about that this year, our second year doing it.
And Chase, 100% of the money goes to the families and so forth. There's no expenses. There's, some of these charities, there's like a 70, 80%, and that's all they get.
Yeah.
Yours is all volunteer. Nobody gets any salary.
Yeah, there's no salaries. There's no real administration costs. I mean, I still do have to pay for, like website services. Yeah. I started kind of paying for some marketing type things because I need to drive that up, but nobody takes any money from it, which is something I'm very proud of.
Yep, and it's a great charity. So what's it again, real quick?
Fighters Fight Foundation. Go to fightersfightfoundation.com.
Great. All right. Well, thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306, or visit our website, smartinvesting2000.com. That's smartinvesting2000.com. And for more daily educational information on investment tips, Go to our Facebook page, Smart Investing with Brent and Chase Wilsey. Closing song, Frank Sinatra's My Way, is performed by the local entertainer, Ron Palacios. Have a great day. Thanks for listening to the Smart Investing Show. We'll be back next week. Have a good weekend.
And may I say, not in a shop.
This program is sponsored by Wilsey Asset Management.